Welcome, everyone, to another edition of the Tony Sirianni podcast. I am thrilled to have my friends from Dynasty here with us, Sam Anderson and Harris Baltch. Thanks for being with us, guys. Appreciate it.
Thanks, Tony.
Sure.
Great to be with you, Tony. Thanks.
So, look, we're feels like we're constantly, I was going to say we're an industry that's in the middle of change, but we're constantly in the middle of change. Things have moved faster and farther in the last, 5 years than in the previous, 70. So it's just been a lot happening. And it seems to me, my contention is anyway, that sort of dead center of all this change are things that you guys are involved with. These are, you guys are, co-heads of M&A, at Dynasty. So you're really kind of in the middle of it. But I see today versus 10 or 15 years ago, everybody talking and concerned about equity and strategies around financing and all that. And it seems that your job is taking on a role that really would help advisors, but I think a lot of ways they don't know how to use an investment bank. You know what I mean? They hear about all these things, and I really do think that equity and things like that are a real motivator today, versus where they were, 10 years ago in terms of having guys move. Everybody wants partnership, that kind of thing. So when you guys think about the business, well, let's start with you, Sam. When you think about it and you take a look at it, and I always think it's interesting to talk to someone, who's a banker and maybe can be a step back sometimes from it. So what are you seeing in regards to those trends and where you guys are fitting in?
Yeah, I think it's an interesting question. I mean, what we're seeing in terms of trends is that, partnership matters, taking care of your clients, separating advice from custody, from product, and building real businesses. And th these RIAs who are launching independently are creating real enterprise value, and I think aligned with their clients. And one of the things that as they're building these businesses and or breaking away from other institutions that they need help with is how do we build a capital structure? How do we reward employees? How do we deal with equity or equitizing employees? And what are the different share class structures? Those are a lot of the things in terms of the building blocks that they need to be thinking about and putting in place for long-term value creation for themselves and their partners.
Yeah, I mean, Harris, the enterprise value and equity are intertwined, right? And especially more today than they've ever been. What do you tell folks who come to you, like a CEO? Because all the things that Sam just talked about, that's not the stuff you think about when you start being a financial advisor, right? You're not thinking about those things, but they turn out to be super important. You mess up your cap table, you've messed up your firm, right?
Yeah, and it's really interesting because when we're speaking with prospects, advising clients on deals, looking at various structures, at the end of the day, it really comes down to only three components. It comes down to payout, it comes down to equity, and it comes down to structure. And between those three levers, you can really think through what's optimal, for your team, for your clients, and ultimately for yourself. And so as we embark into the next year, you're really seeing an ecosystem that continues to be highly fragmented.
Yeah.
And with the private equity backdrop, it's continuing to fuel consolidation. So big firms are getting bigger, they're becoming more complex. And you're also seeing a lot of firms try to take advantage of some of the centralized scale that's going on across our industry, whether that has to do with taking advantage of a scaled investment platform or a scaled M&A
Yeah.
capability, or just using scale in order to provide all different types of holistic wealth management solutions to your clients. Because let's face it, as the U.S. as the U.S. becomes a bigger, more powerful, and wealthier country, our clients are demanding more. And in order to have a centralized ecosystem of services that you can utilize in order to serve your clients is becoming more and more important.
Yeah. I mean, so Sam, Harris brought up scale, right? So that's one of the things advisors look at, and when they're looking to build enterprise value or equitize, as you said, but scale and your partner in scale really matter. I mean, is this advisors don't usually ask, I don't know, I feel like they don't ask the right questions when they're sitting down. And that's kind of, you understand this marketplace, but typically an advisor doesn't, has not been through one of these transactions before and maybe, sees the scale, is dazzled by it. I get the idea, but they don't understand that there's a 5-year time horizon where this might change somehow or another, right?
Yeah, I think, when you're thinking about it through the lens of what is the right long-term plan for me and how do I operate in an environment where it's good for my clients
Yeah.
and I can create significant wealth for myself and my partners and all of their families. It takes a lot of planning. It also takes built doing the little things right along the way, and making sure that you're optimizing, your profile for that buyer set that Harris was referencing. And part of that is, having scale. Part of that is being able to be competitive with all the best platforms out there, even if you maybe are a smaller platform. So synthetic scale matters. And
Mhm.
then information, right? Making sure you really understand the business, making sure you have good financials, and that is very accessible for a buyer. So private equity firms and other strategics will pay a premium for those companies that are well run, are platform players, even if they're not significant in size by way of the broader market if they operate that way. And a private equity firm feels comfortable that the management team, the systems, the operations, the infrastructure can scale. That really drives a premium in the market.
And you would be, you talk to these guys about, sometimes advisors don't necessarily speak the language or, recognize what dilution might mean or where it is, right? Or what's a waterfall? Where do I stand in that? I mean, right? I mean,
Right.
how do you talk to them about things like, I mean, I'll tell you one other thing about advisors is they're like, doctors as clients. They don't want to sound stupid. So they don't want to sound like they don't know, right? But at the same,
Right.
because it's kind of, this isn't their business, but it's not their wheelhouse, right? So how do you talk to them about it?
Uh, you
Well,
know, you go ahead, Harris.
I think you have to keep it simple, right?
Yeah,
If you think about the KISS analogy on what are the different components that they need to be considering when evaluating different types of opportunities. And, part of our job as an investment banker to a lot of these wealth management platforms, Tony, is to help them really understand and really provide an apples to apples comparison across different
right.
types of firms
That's
that they may
critical,
be
right?
having.
That's
Yeah.
yeah, that's critical. I mean, because you
Yeah.
can't. Everything is so different, and also I would imagine that what they want is different, right? Hey, I want to retire and I need a succession, or I want to pass this on to my kids, and that's probably two different conversations.
Well, that's why it's not uncommon for us when we're evaluating different opportunities on behalf of our clients is to really scorecard them out.
Yeah,
It's not uncommon for clients to come to us with scorecards of criteria, and they just don't know how to fill in those
right.
criteria effectively across different firms that may be calling on them or firms that they've never heard of before. And so when they're going through a process and having conversations with executives across the deal table, really understanding, what comprises of their culture, how do they provide their advisors with autonomy. How are they going to improve the overall client service experience or the service experience for the advisors is incredibly important. And so we spend a lot of time making sure that our clients are trying to not just chase value, but also make sure that the overall client experience is going to be improved.
Yeah. So, Sam, I don't want to put you on the spot with it, but the flip side of that's also true, right? You want to rely on you guys to have experience to know who these players are and what their end game is. So, I'm aligning with this guy, and no offense, but the banker may say one thing, and you happen to know that this is what this is their goal or plan, correct?
Yeah, I've had the unique experience of being both a banker and I'd say reformed banker because I've been on the other side of it, being banked by, all the big firms on the street as an executive. So, I mean, I think, the trust you have in people that are helping you along that journey is in a way the same trust that you want your best clients to have in you as an advisor.
Yeah.
And that trust in laying out the options, as Harris said, being really objective, doing the diligence and the work to make sure that someone has the information to be
Mhm.
making an informed decision. And the decisions people make, as Harris mentioned, are unique and individual. Like there's not a one size fits all,
Right.
but the way you lay out the decisions and the way that you help educate people and make the complex simple, that is really important.
So that leads to the big question, which is, well, why Dynasty? What makes Dynasty different than, everybody else? What's the value prop for an advisor coming in? Well, obviously we mentioned some of them, but
Yeah, I think just to hit that head on, it's pretty unique what we're doing here on at Dynasty. I mean, first of all, having an investment bank that's attached to a platform that
yeah,
supports
that's cool. Yeah.
independent RIAs across the country. I mean, today we have over 60 teams, over 200 billion of AUA across the U.S. We get exposed to a lot of different situations, which in some ways is a cross section of what a lot of our clients, whether they're inside of our core network or outside of our core network, are facing. And so,
And just one
having
thing, you say so it's you also do outside firms, not just Dynasty firms.
That's right. I mean, we don't keep our capabilities captive exclusively to our clients, and it's kind of ironic, but our clients sort of demand that because
Yeah.
if it enables us to bring the best information about the pulse of the market to both clients inside and outside of our core network. But between Sam and myself and our team, I mean, a lot of us came from bulge bracket investment banks, and having the ability to provide that big cap experience working on both U.S., non-U.S. deals, public-private deals, well in excess of the enterprise value of a lot of the clients that we support today. It really enables us to provide a differentiated level and discipline of advice that we can now provide to the masses. And so having that level of experience and the insights from the broader Dynasty platform really allows us to be a top-tier advocate for independence and providing the best advice, regardless of what our clients' objectives are.
Yeah, I mean that go ahead, Sam.
I would just add to what Harris is saying, and I agree with everything. Reciprocally on the buy side. So when we're advising clients on looking at buying a particular business within the RIA space, I really don't think there's anyone else that has the level of expertise that we have in terms of doing that diligence, thinking through everything from is it a good team? Is it the right client mix? All the way through to executing and onboarding that target acquisition. And most bankers stop with, hey, I'm gonna like negotiate this deal, it gets signed, and we walk away. Whereas we are bringing to bear all of the experts within each discipline, whether it be operations or technology, doing really deep dives on the platform from a diligence perspective, negotiating, structuring the agreement, as well as executing the onboarding and integration of those. I mean, think about in the history of M&A broadly, there are a lot of great deals on paper.
Yeah.
A lot of deals fall apart on the execution and integration side. So we de-risk that as a platform. And, I think we're really unique versus other platforms that don't, quite frankly, have that expertise, capability, or people.
Well, I mean, look, Sherrill was there 10 years. They were the first guys through the window with
That's right.
Hightower and everybody else, right? I mean, that was
Yeah.
the way it was. I recall it very well. Um, So let's get it down to sort of specifics now. If you're CEO of an RIA, right? What do they typically, come to you for? And then what do you think? I going to be two questions. So one of you guys talk about what do they typically come to you for? Harris, why don't you do that? And then Sam, you talk about what should they be coming to an investment banker for, right? So go ahead, Harris. What do they typically come to you asking?
Well, a lot of times people come to us because they think they want to do something,
Right.
right? And so the initial ask is really coming to us to get educated on what they think they're worth, what they think the market looks like for a business of their size and scale, and they want our views on how we could conduct a process. And through those conversations, we perform a tremendous amount of due diligence to really provide them with a bespoke view of those three things. And ultimately, if they feel like the timing is right, and timing has a lot to do with a
Yeah.
lot of this, we formally engage. But that's really on that's really on the sell side. I mean, we have clients that come to us, as Sam mentioned, that really want to have a buy side strategy, and what's the right approach for them in terms of the discipline. Are they recruiting advisors? Are they buying RIAs? Are they using debt in order
Right.
to finance the acquisitions, or are they using equity, or is it a combination of both? And sometimes folks are looking to just try and have an internal succession strategy, and they don't have a view of what they're worth or how they can establish the right level of currency and also set up the right level of governance. I mean, a lot of these firms are cottage industry businesses that set up an operating agreement with maybe one sheet of paper in order to incorporate and start their business. And the industry has evolved so much over the past 15 years that they really come to us to help professionalize and think through
Yeah.
how to take their business to the next level.
So when hearing that, Sam, what are the best practices? So what would you like to see them, do, or what are the things they should do? Like the couple things that would be best practices if you're an RIA CEO and you're looking to professionalize your, what you have. What would you like to see them come to a banker for?
Yeah, I mean, that's a great question. I mean, most often, and I've seen this even outside, with companies getting ready to even go public, right?
Right.
So this is not unique to I would say a smaller to mid-size RIA, call it $1 billion to $5 billion, and larger coming to market, or thinking through kind of what do I need to do to prepare. One of the things I think that's really important is making sure your financials are really squared away. You've got audits, and
Yeah.
we, help facilitate all of that. Two, thinking through cap structure, like what kind of capital do you want? Like, do you want a minority investor? Do you want a majority investor? What does that mean? And really unpacking like what they really want.
Right. And
And
why?
sometimes
And why
that's
do you want?
and why and what are the motivations? Do they want to stay on? Do they not? Some of the things you mentioned earlier, really digging into that because that can matter in terms of who you're getting the capital from,
Yep.
what the structure of the capital is, and also what the timeline of the capital is. Some buyers want to be able to force a sale of your business within 5 years. There's lots of reasons for that. Other capital is longer term, and meets maybe more the objectives of someone that wants to pass their business on down to the next generation, but needs a capital provider that's long term. So
Yeah.
there's lots of nuances like that. And then I think the team, right? So making sure that you've got your culture, really aligned, and, from an like work on the business, not just on building the business, and
Yeah.
making sure that, you present operationally, finance, making sure, you are able to articulate your tech stack. All those things make going and sitting in front of a buyer and doing diligence much easier, and the results are better.
Oh, great. The last thing, because believe it or not, we're getting there time-wise, but Harris brought up valuations. So, we got to talk about that. And, so Sam, why don't you say where do you think they're going in the next couple of years? Where valuations going?
Look, I think there's going to be continued interest in this space. There's a lot of capital chasing it. But I think the differentiator between the platform folks
Yeah.
and the folks that are out there being aggregated into the platform, those two things are going to continue to be increasingly discerning because, from the lens of an investor, because investors are willing to pay for, high to mid 20s for platform folks
Mhm.
that they really believe they can grow. And for the folks that, maybe don't present that way, maybe haven't thought through some of the issues we talked about,
Yeah.
they're lower.
Right.
But look, the overall industry continues to grow. We see, the independent movement continuing to be an important driver. And, capital sources out there and investors, really believe it's a long-term trend.
Harris, what's next in the marketplace from your point of view? Like where's this going from 5 years, just in general, as
Yeah,
not
I
your
think
valuations.
yeah, Tony, I think from an overall, ecosystem standpoint, you're going to see the bigger RIAs get bigger. And so what does
Yep.
that mean? You're going to see regional firms become national firms become international firms. and really express their view on wealth in a variety of different ways. And so while that happens, you're going to see, certain wealth management firms build out specific disciplines, right? And that could be a certain niche capability. It could be a certain type of organic growth strategy. It could also be a certain demographic that they specialize in, right? Some firms may focus exclusively on firms that, are more mass affluent and maybe have an average net investable asset base of less than $1 million. And on the flip side, you're going to see, big RIA platforms get created that focus exclusively on the ultra high net worth, borderline multifamily office. And so doing things like not just asset management, but also providing very specialized wealth management planning, providing tax advice,
Yeah, for sure.
estate and trust planning. And so, firms that are growing into those different niches are going to become more desirable to build out their capability set to, serve their clients better.
Yeah, well, look, it sounds like it's still an exciting time to be in this business. So I'm happy I'm happy that we are, believe it or not, we're done for time. That's kind of a high note. Unless Sam, it looked like you had one other thing you wanted to say. No, you're good. All right, good. Well, we'll do this again, guys, so we can, certainly revisit this as time goes on. So I appreciate, y'all being here. And I do think that equity is, and partnership and people's notions around how they want their firm structured is the big driver today of advisors are voting with their feet for the platforms that they like. So it's exciting to be in the middle of it. Thanks a lot, guys. I appreciate it.
All right,
Thanks,
thanks for
Tony.
having us.